I've been getting several questions about annuities lately, and somebody asked if I would just do a little tutorial on annuities and talk about them for just a second. Now, just got off the phone with a lady, as a matter of fact, and she was saying that she had this money, and I said, well, whatever you do, she needed to have some money set aside in cash and set aside for emergencies. So whatever you do, when you go into the banks, a lot of times they're going to talk to you about annuities, or you talk to a financial person, they're going to talk to you about annuities. Why? Because the commissions are so good on annuities. They're what we call a non-breakpoint product, or what I refer to as a non-breakpoint product. Typically, when you buy mutual funds, what will happen is a lot of these funds will have commissions on the front end. They'll be front-end loaded mutual funds where they'll pay maybe a 5 3/4% commission for buying the fund. Well, what happens is as your deposit amount goes up, the commission level or the percentage goes down. So if I put maybe $25,000, my commission will go down to 4.5%. If I put $50,000 in, it may go to 3%, and so on and so forth. Well, annuities, what happens is typically when you put an amount of money in, no matter how much money it is, a lot of times the commission will remain the same as a percentage, and many times it will be much higher than what typical mutual funds will pay. So there's a huge incentive to sell annuities out there in the financial world. Just keep that in mind when somebody's talking to you about them. Now, I may have to do several parts on this because there are so many different working parts about annuities and how they work, but let me just talk about what annuities were initially designed to do. Annuities are basically a product where if I have a certain sum of money, let's say if I've got $100,000 and I want to put money away and I put it into an annuity, a lot of times advisors use them as an accumulation vehicle. They pay interest in a fixed annuity, and that interest, you don't have to pay taxes on it until you pull the money back out. Well, what happens is they are what's called a last in, first out type vehicle. Last in, first out. In other words, if I have that $100,000 and it grows to $115,000, then the money that I pull out, the first $15,000 will be 100% taxable. I only get my principal back later on. So what ends up happening is it's a very tax inefficient way, really, of getting money back out. Now, another way that you can get money back out is to do what is called annuitizing the vehicle. Now, the vast minority of people will ever annuitize an annuity. And what that is let's say if I put $100,000 in and I have a 20-year life expectancy. So I have this 20-year life expectancy, and I don't know exactly when I'm going to move on. So what happens is that the insurance company says, hey, you got $100,000. We'll pay you, there's a certain amount of interest that the contract pays, let's say 3%. But if you pull the interest off, you'll be earning $3,000 per year. What if we do this? We'll have you hand this money over to us, the insurance company, and over a 20-year time frame, we will give you a little bit of your principal back plus the interest earned, and we might be able to increase that distribution to 5% or 6%, or sometimes, if you're older, 7 or 8% of the value. So if I have $100,000 and the distribution rate is 6%, let's say, then I get $6,000 a year. Now, if I have a straight annuity and I die 2 years later, the insurance company wins. They get to keep the money. If I live, instead of 20 years, I live for 80 years, then I win. I actually got a whole lot more money than I would have had I tried this little trick on my own. So that's the concept of annuities. They had a great premise when they were first developed as a way of going and transferring risk of living too long to an insurance company. The problem is this. Fixed annuities, like I'm talking about right now, their investments are backed by typically bonds and fixed income investments, the insurance company assets. Now, insurance companies have to typically be very, very conservative in their investment management. Now, fixed income investment vehicles, as we have talked about many times, takes about 100 years for money to double historically in the shortest term fixed income investments. So in inflation, and the ability to beat inflation is very, very poor. For example, if I'm taking a $6,000 income per year and I look at just inflation over the past 20, 30 years, literally that halves in value every about 12 to 14 years. So literally, I'm 65, and just 12 years later, the purchasing power is only $3,000. A few years later, it's only $1,500. So as you can see, your standard of living can drop in a hurry with these investment vehicles. And from an investment perspective, that's not really what you want to have happen. Now, as for going in more detail about this, I'll do that in future videos, but that's enough for right now. Thanks for tuning in.